The last thing that we cover in chapter 18, or I guess one of the last things, because we're also going to talk about a balanced scorecard, is variable versus full costing. So full costing is the costing that we've been looking at from everything to here. The contribution income statement is often called variable costing because it separates those variable and fixed costs. The full costing is required by GAAP for financial reporting and by the IRS for computing taxable income. It's required for how we carry our inventory and in cost of goods sold. So full costing satisfies our matching principle, but variable costing allows us to look at things in a different way for performance evaluation. So when we use variable costing, this is when we separate out the variable and fixed costs. Under variable costing, all fixed manufacturing costs are treated as period costs. In reality, in full costing, which we know, fixed manufacturing costs are product costs or inventoriable costs. So we're not using variable costing for any costing thing other than performance evaluation and planning and decision making. It's not used to value inventory or to determine cost. So when we look at our variable versus full costing, so we have our information here. In our inventory increased by 40 units. Our beginning inventory, we sold 60 units, we produced 100 units. So in period 2, we had beginning inventory of 40 units, we sold 140, and we produced 100. When we look at the full costing versus variable costing, our net income is higher under full costing in this example, and the variable costing gives a lower number. This is because our fixed costs that would normally go into our inventory are now part of our period cost when we're looking at this. So we see that that difference in ending inventory is $1,600, which gives us a difference in income of $1,600. This is caused by if we see a beginning inventory, so our difference in beginning inventory is also $1,600, giving us a difference in income of $1,600. So if we use full costing, which is required under GAAP, and we stock excess inventory, so we stock more inventory than we sell, we can manipulate our total net income versus variable costing. And this is one of the reasons that we want to look at the full costing is just our normal financial records. So we want to look at variable costing income statements for performance evaluation measures to make sure that managers aren't using inventory manipulation in order to make their numbers look better. So we see the full costing net income exceeds variable costing by the amount of fixed costs in our inventory change when inventory decreases. Our variable costing net income is higher than full costing net income when inventory decreases. Okay? Variable costing is not affected by the change in inventory because all fixed costs are deducted from the income. So it eliminates this incentive for management to overproduce inventory, which can make their bottom line numbers look better under our normal full costing analysis. Our contribution income statement and international accounting standards. So we have about 150 countries that use IFRS reporting standards. So IFRS and the US GAAP are different in a few areas. US GAAP has not fully converged to IFRS, but it is something that has been in process for multiple years, actually more years than I can remember. There are multiple benefits to the US converging with IFRS. One is that US companies that operate in multiple countries wouldn't have to prepare the consolidated financial reports under two different standards. We could also have consistent measurement issues. Some of the differences are that IFRS does not allow for LIFO. So we have a couple of US companies that have some very old LIFO measurement on their records because LIFO is allowed under US GAAP. So if we got rid of LIFO, we would have to do restatement of information. There are a couple other areas where IFRS and US GAAP don't agree and don't seem to be any closer to coming to an agreement on. The contribution income statement and our value streams. So when we're looking at lean accounting or lean manufacturing applications or just-in-time management, then we have value streams. So the value stream income statement shows then the contribution of each of the value streams in the same way that our contribution income statement shows divisional analysis. The last thing that we talk about in this chapter is the balanced scorecard. So we already saw the balanced scorecard in previous chapters, that we look at performance from 4 key perspectives: financial, customer, internal business processes, and then our learning and innovation. So our cost, revenue, and profit centers focus mostly on the financial dimension. When we're looking at a balanced scorecard, we can use these to create performance measurement methods that help with that goal congruence. So we force our managers to make decisions that align with long-term strategies. So our balanced scorecard is really more important in difficult economic times when we might have different profit-based measures. So when we're starting to see right now various companies that have already had their fiscal years ending in 2020, we've seen some extreme earnings dropping because of COVID from the beginning of 2020. And so we're going to see a lot of inconsistencies in earnings and information that we're getting from financial records because of how COVID affected manufacturing and supply chain and our retail practices. So we're going to see some very interesting numbers coming out of 2020 for financial statement analysis. So this is where measures other than just financial statement ratios will help us to evaluate managers' performance when we see dips in those earnings. Okay, we do have implementation issues with a balanced scorecard. So it's not always easy to use the same balanced scorecard against all different centers or our responsibility centers or SBUs. So cost centers can't always be evaluated the same as a profit center or a revenue center. We don't always use that as a way to make bonus decisions or various compensation decisions. And then we also sometimes have issues with the links between the measures that we use to improve performance and any actual performance. So not all of the balanced scorecard measures are an easy thing to calculate and actually measure. So larger firms are going to have what are called enterprise resource planning systems, or ERPs. These systems allow them to collect a lot of information, but smaller firms or firms that don't have these kind of systems in place might not be able to collect information in an easy way. Non-financial information, this isn't subject to accounting regulations or other types of regulations. So it could be unreliable, it could be inaccurate. It depends on who's producing that information from us, where that information is coming from. We often only do performance reviews quarterly or annually, and we might be collecting our other information in a different way. And we can have information reliability issues. In service firms and nonprofit organizations, so we usually use cost center or profit center analysis when we're looking at these. Of course, nonprofit organizations should be controlling their costs, but they're not really looking for ways to generate high profit. So how do we manage our costs without exceeding any of our budgeted revenues? In service firms, we can actually have profit centers because service industries do want to generate income. We just don't have the inventory management part of service firms. And that is the end of chapter 18.